Welcome to the deep dive. Today, we're plunging headfirst into a truly fascinating and rapidly shifting landscape, the Southern California housing market. For months now, we've heard whispers, theories, even, hopeful predictions from some corners. But as we sit here today, the data isn't just whispering anymore, it's screaming. Southern California's housing market has experienced a profound shift, marking a significant and undeniable downward turn. We're witnessing a massive surge in inventory, unlike anything seen in years. And crucially, home values are now officially dropping month over month across key areas of this, well, highly watched region. This isn't just a minor blip on the radar, something to shrug off. This is a significant correction, a recalibration, and it carries profound implications for anyone looking to buy, sell, or frankly, anyone just trying to understand the economic pulse of this vibrant yet often perplexing part of the world. What are the underlying forces that have caused this sudden and dramatic turn? How much further could prices realistically fall as we look ahead into 2025 and 2026? We're going to systematically unpack every one of these forces at play, meticulously examine the very real numbers driving these changes, and explore precisely how this dramatic shift is playing out on the ground in critical areas like Los Angeles, Orange County, and San Diego. Our mission today is to give you an unparalleled shortcut to truly understanding this complex, often confusing situation, transforming raw, sometimes overwhelming data into clear, actionable, and truly insightful knowledge that you can use. So let's begin by unpacking this immediate and very real news. Southern California, specifically focusing our lens on Los Angeles, Orange County, and San Diego, has unequivocally seen a definite downward shift in its housing market. We're not talking about forecasts or predictions here. This is a measurable, tangible decline already in progress. It's a critical moment considering the trajectory we've been on for so long.
What's truly fascinating here, perhaps the most definitive signal, is that home values officially declined on a month-over-month basis in April 2025 across all three of these major counties. This marks a profound turn. To put it into perspective, as recently as the last year, values in Orange County were still up by a substantial 6.4% year-over-year. Many other areas were also showing consistent year-over-year gains. So for the market to now show a uniform month-over-month decline across the board, even in areas that were recently exhibiting remarkable strength, unequivocally signals a crucial and undeniable change in momentum. It's a clear indication that the previous, seemingly unstoppable upward trend has been decisively broken, and we are now collectively moving in the opposite direction. This isn't just a pause, it's a pivot.
Okay, that sounds significant. But what truly underpins this shift? Here's where it gets really interesting, because the inventory metrics are absolutely exploding. This, in my view, is perhaps the clearest and most dramatic signal of the market's correction, far more telling than just a subtle dip in prices. The sheer volume of homes suddenly hitting the market across Southern California is, frankly, unprecedented in recent times. What are the numbers telling us about this surge?
The numbers truly paint a stark picture, and they speak volumes about the shifting power dynamics. In Los Angeles County, for example, inventory is up a staggering 47% year-over-year. Think about that. Nearly half again as many homes are available for sale compared to just 1 year ago. Orange County, often a bellwether, leads with an even more dramatic increase of 79% year-over-year.
79%, wow.
Yes, 79. That's almost double the number of homes on the market compared to the previous year. And San Diego County isn't far behind, with inventory up a substantial 66% year-over-year. This rapid, almost vertical increase in available homes isn't a slow adjustment. It's a rapid expansion of supply across all price points. It tells us, without a doubt, that the market is truly correcting. For prospective buyers across Southern California, this could finally be the much-needed price relief many have been desperately waiting for, fundamentally shifting the dynamics significantly in their favor. It's a stark reversal from the chronic undersupply we've witnessed for years.
It's a shock because for such a long period, it truly seemed like nothing could halt the upward trajectory of these markets. The dominant narrative was perpetually about limited supply, fierce competition, and a relentless march towards ever-increasing prices. It felt like an almost unstoppable force. But now it appears the tide has turned, and quite abruptly. What are the deeper implications if this explosion of supply continues?
Well, this raises an important question. If inventory continues to climb at this accelerated pace, those lingering positive year-over-year figures we might still see in some specific areas like that 6.4% gain in Orange County that we mentioned are simply not going to last much longer. The momentum is clearly and decisively shifting. The sheer volume of new listings pouring onto the market is fundamentally altering the supply-demand balance in a way we haven't seen since, well, before the last major downturn. What was once a market where sellers could confidently dictate terms, routinely expect multiple bids, and even command prices above asking, is now rapidly becoming one where buyers have a growing number of options, significantly more leverage in negotiations, and crucially, more time to make considered decisions.
Pro leverage, right?
Exactly. This explosion of supply meeting a constrained demand is the natural economic consequence, and it is reshaping the entire landscape of Southern California real estate, forcing a reckoning with pricing expectations.
Okay, so we've seen the hard numbers on exploding inventory and the initial definitive price drops. But to truly unearth the why behind this seismic shift, we need to dig deeper beyond just the symptoms to the core affliction. The fundamental issue, the root cause underpinning all of this, is that prices have reached absolutely extreme, unprecedented highs. They've soared relentlessly over the last decade, and especially over the last 3 to 4 years, creating a dramatic disconnect. What are the direct consequences of these astronomical prices for local buyers?
Well, the reality, as our data clearly shows, is that many local home buyers in Southern California are simply priced out. They are looking at these astronomical prices, even for what might be considered a very standard or modest home in a non-crime area, and they're quickly realizing a harsh truth. They cannot even qualify for a mortgage to purchase one.
They just can't qualify.
Right. This isn't about personal preference or choice. It's about sheer financial feasibility. Their income simply doesn't stretch far enough to meet the current mortgage requirements. This systemic inability for a large segment of the population to qualify has resulted in a significant and undeniable reduction in homebuyer demand, which is now vividly visible in the transaction volumes. People might have the desire to buy. They might want to own a home in Southern California, but if they can't secure a loan, or if the projected monthly payments are simply too overwhelming for their budget, that desire unfortunately doesn't translate into an actual sale.
Let's put some numbers to this reduction in demand. We're talking about a significant, measurable drop in actual home sales across the region, which paints a very clear picture of just how many potential buyers have been effectively pushed out of the market. It's not just an anecdotal feeling. The sales data is confirming this widespread shift.
Yeah, the sales numbers are quite stark, especially when you compare them to both historical averages and the peaks we observed during the pandemic era frenzy. In Orange County, for instance, home sale transactions are down almost 45% from their pandemic peak.
45%. That's huge.
Huge. To grasp that, imagine nearly half the number of sales compared to just a few years ago. Furthermore, they're approximately 24% below the long-term average for the area. This isn't a minor dip. It's a substantial contraction in market activity. San Diego saw only 2,300 home sales in April 2025. While that figure shows a slight recovery from its recent absolute lows, it's still about 25% below its own long-term average. Los Angeles, the largest market, demonstrates a very similar trend, underscoring a widespread and significant reduction in buyer demand across the entire Southern California region. This data collectively tells us that the active pool of qualified buyers has shrunk considerably, fundamentally altering the dynamics of supply and demand.
That's a crucial observation. It's interesting because for a couple of years there, this low buyer demand wasn't so glaringly obvious, even as prices continued their ascent. It truly felt like the market was still red hot, even if fewer people were actually managing to close deals. Why was that? What created that illusion of continued strength?
That's a critical question that reveals a lot about market perception. The primary reason for that apparent disconnect was the incredibly low inventory we experienced. Even with reduced buyer interest, and the demand was, in fact, already lower than it appeared, the sheer scarcity of homes on the market created a powerful perception of strong demand. With so few homes available for sale, even a smaller pool of active, qualified buyers still led to intense competition, triggering bidding wars and driving values relentlessly upward.
Right, the bidding wars.
Exactly. In places like Orange County, this dynamic meant values went up as much as 7–8% over the last year, despite the underlying demand issue lurking beneath the surface. However, the calculus is changing dramatically now. The big difference in 2025 is that more and more sellers are finally coming to the market.
So supply is finally catching up, or rather surging.
Precisely. This increased supply is rapidly exposing the true underlying level of buyer demand, or rather the stark lack thereof, at these current elevated price points. The illusion of perpetual high demand is dissolving under the weight of new listings.
This leads us to another vital question. Why are these sellers who seemed so content holding onto their properties suddenly deciding that now is the time to list their homes? What has fundamentally changed in their circumstances or perceptions to make them bring their properties to a market that is clearly starting to cool?
Well, there are several compelling factors at play, and it's likely a combination of these that is contributing to the current surge in listings. One simple explanation is that some sellers have simply waited long enough. They've witnessed their home values skyrocket over the past few years, riding the incredible peak of the market. Now, they might be looking to finally cash out, capitalize on those substantial gains, and move forward with long-delayed plans, whether that's relocation, downsizing, or investing elsewhere.
Makes sense. Cashing in the chips.
Right. Another significant factor could be the gradual easing of the mortgage rate lock-in effect. For years, homeowners with ultra-low interest rates from 2020-2021 were hesitant to sell, knowing they'd have to finance their next purchase at much higher rates. But as some of those plans become unavoidable, or as the realization sets in that interest rates aren't likely to plummet back to those historic lows anytime soon, the resistance to sell may be weakening.
And maybe broader economic pressures, too.
Absolutely.
Yeah.
We also need to consider broader economic pressures. While Southern California remains a robust economy, there could be localized economic issues cropping up.
Right.
Rising property taxes, escalating insurance costs, the general increase in the cost of living, groceries, gas, you name it. All of these factors reduce disposable income and can make holding onto a high-value property more burdensome. Or perhaps there are shifts in the job market, particularly in sectors like tech or entertainment, that have a strong presence here, which might be pushing some individuals or families to reevaluate their financial positions. Finally, there's the psychological element, a growing perception that the market's peak is past. When sellers see inventory rising and price cuts appearing, a sense of fear of missing out on a good sale can turn into a fear of falling further, motivating them to list now rather than wait for potential deeper corrections.
Interesting. So a mix of practical reasons and market sentiment.
Exactly. All of these elements are directly contributing to the skyrocketing inventory we're seeing as more people collectively decide it's time to sell rather than hold.
Southern California's housing market has been on just an incredible bull run for almost 13 years, with values consistently increasing, often defying gravity and historical patterns. It seemed almost immune to typical economic cycles. But the profound shift we're discussing raises the existential question. Is this long, extraordinary run finally coming to an end? Are we truly at the precipice of a more sustained downturn after such a prolonged period of unprecedented growth?
You know, if we connect this to the bigger picture, the comprehensive affordability metrics we analyze strongly suggest that the answer might indeed be a resounding yes. This isn't just about high nominal prices, which are certainly a factor. It's fundamentally about the overwhelming, almost prohibitive cost of financing those prices, especially in the current elevated interest rate environment.
The financing cost, right?
Yeah. The market has simply become unmoored from local incomes, creating an unsustainable dynamic that's now visibly fracturing. When you look at how much a typical household income is required to even afford the mortgage on what might be considered an average or modest home, it becomes glaringly clear that this prolonged bull run has pushed homeownership far beyond what the average local resident can reasonably bear. This level of disconnection can't last indefinitely.
Let's zero in on Orange County, an area many of you are intensely interested in, and one often considered a bellwether for the broader Southern California market due to its unique demographics and demand. The typical house there, perhaps a 1,600 square foot property on a relatively small lot, by no means a luxury estate or a newly renovated showpiece, is now valued at a staggering $1.1 million. Think about that. $1.1 million for a standard, often unrenovated house built decades ago. That's a truly astonishing figure that forces us to question who can even aspire to live there.
It truly is an extreme figure. The previous peak for Orange County was $1 million back in 2022, after which it dipped slightly to around $990,000 before recovering and then pushing up even further to today's levels. But what's truly eye-opening and profoundly indicative of the extreme unaffordability is the mortgage payment-to-income ratio, which is now up to a staggering 80% in Orange County.
80%?
80%. To break that down, this means a typical household in Orange County would need to dedicate an overwhelming 80% of their gross income just to cover the monthly mortgage payment, which includes property taxes and insurance.
Wow.
This clearly indicates that an alarmingly small percentage of local people can actually afford to buy a house with a mortgage. It's an almost insurmountable financial hurdle for the vast majority of wage earners in the area. This isn't about saving up for a down payment anymore. It's about the monthly carrying costs being fundamentally out of reach.
That 80% figure is absolutely astonishing when you consider the long-term historical average for that metric. It signifies that what was once a financial stretch for many is now entirely out of reach for almost everyone who earns a local income.
Indeed, the contrast is stark. The long-term average for this ratio in Orange County is 49%, meaning historically about half of a typical household income would go towards their mortgage. Even that, by national standards, is high.
Still high, yeah.
Right. And prior to the pandemic, you could typically... So while Orange County has always been an expensive market compared to other parts of the country, it was at least accessible to a significant portion of the local workforce. Now, that is simply no longer the case. People genuinely cannot qualify for homes here because the income simply isn't there to support these payment levels. This disconnect fundamentally cripples demand from the local population, leaving the market increasingly dependent on cash buyers or those with external sources of wealth.
So, what does this extraordinary level of unaffordability portend for the future trajectory of the market? Are there any historical parallels we can draw from such extreme conditions to understand what might be coming next?
Well, the last time affordability was this stretched in Southern California,
Right.
with mortgage payment to income ratios reaching such extreme levels, was during the infamous 2006 housing bubble.
2006. I remember that well.
Yeah. That period, as many will vividly remember, eventually led to a massive and painful crash in home values across the region, and indeed much of the nation. While historical events don't perfectly repeat themselves, every market cycle has its unique nuances. This striking parallel raises an incredibly important question about how long current demand can remain frozen under such prohibitive financial conditions. If local buyers, the natural engine of the housing market, are fundamentally unable to participate, and the market becomes reliant on outside cash, remote workers with higher salaries, or highly specific circumstances, that's simply not a sustainable model for long-term price growth. This suggests that a significant price correction is not just possible, but increasingly probable and even necessary to bring the market back into some semblance of balance with local incomes and ultimately make it accessible again.
Shifting our focus a bit south, San Diego is unfortunately showing a very similar picture in terms of affordability, mirroring Orange County's struggles almost identically. It seems this challenge of extreme housing costs versus local incomes is pervasive across the entire Southern California coastal market, not just isolated to one area.
Absolutely. The data confirms this widespread issue. The mortgage payment to income ratio in San Diego stands at a daunting 69%.
69, still incredibly high.
Very high. To put that into a more tangible perspective, if you were to buy a typical house with a mortgage in San Diego today, your average annual payment, including taxes and insurance, would be around $74,000 a year, or roughly $6,000 a month. This payment alone consumes 69% of the area's median income. It's critical to note that San Diego actually boasts an above-average median income compared to many other major metropolitan areas in the country, yet even that isn't nearly high enough to support these current prices and mortgage rates for the average household.
Right.
The long-term average for San Diego is a far more manageable 46% mortgage payment to income ratio. So much like Orange County, it's significantly disconnected from its historical norms, making sustainable homeownership a near impossibility for the average local earner.
Given these stark figures, what does this tell us about the San Diego market's potential for recovery? If demand is essentially frozen because the vast majority of people simply cannot afford to buy, how does that translate into future market movement or a potential rebound? What's the threshold for improvement?
This metric is incredibly crucial for understanding the immediate future of the San Diego market. So long as the mortgage payment to income ratio remains in this elevated 60% to 70% range, we are going to continue to see severely frozen demand in the San Diego County housing market. Demand simply won't return in any significant volume until this ratio drops down to a more normal, sustainable level, ideally closer to its historical average.
Back towards that 46% average, perhaps.
Ideally, yes, or at least significantly closer. This metric is crucial for understanding precisely how overvalued the market is today and, conversely, what threshold we need to cross for demand to truly rebound and for the market to achieve stability. Until a typical household can realistically afford a mortgage payment without dedicating the vast majority of their income to it, the market will remain stagnant, leading to continued downward price pressure. It's a fundamental economic reality. Prices must align with the purchasing power of the majority of potential buyers, and right now, they are vastly out of sync. This means either a substantial reduction in home prices, a significant drop in interest rates, or a dramatic increase in local incomes. Likely a combination of the first two will be necessary for a true rebound.
Okay, we've delved deep into the overarching data, the exploding inventory, and the pervasive affordability crisis. Now, let's bring it down to the ground level, beyond the abstract numbers, and see what's actually happening with properties currently for sale in these markets. What we're observing are more and more price cuts appearing with increasing frequency. This isn't just theory anymore, it's the practical reality playing out in real-time listings across Southern California.
That's absolutely right. These price cuts are not just isolated incidents. They're becoming an increasingly common feature of the market. Take Orange County, for example, which, as we discussed, is now comparable to San Francisco in terms of buying houses dollar for dollar. Even in this exceptionally high-cost environment, sellers are realizing that their initial pricing aspirations are out of step with what actual buyers are currently willing or able to pay in this new shifting environment. This necessitates adjustments.
We've identified a particular listing in Orange County that really illustrates this point. A single-family home that has seen a substantial $150,000 price cut, bringing its current asking price down to $1.2 million. This isn't a grand estate. It's a 4-bedroom, 3-bathroom house built in 1950 that, from the listing, clearly hasn't undergone significant renovation in quite some time. It's not a turnkey luxury property, yet it's priced at $1.2 million.
And the estimated value for this specific house, according to our models, peaked at $1.2 million back in 2022, dipped slightly, then surprisingly went back up, and now the seller is making these rather significant cuts.
That history is interesting in itself.
It is. And this house's estimated value has still gone up an astonishing 82% in the last 10 years, which profoundly illustrates the incredible bull run and the massive run-up in prices that Southern California has experienced. Even with this recent $150,000 price cut, it still represents a substantial gain for the seller, far exceeding inflation or average wage growth. However, if a buyer were to purchase this house today with a $1 million mortgage and a $200,000 down payment, their estimated monthly payment, including property taxes, insurance, and likely some maintenance for a 1950s home, would be around $8,000.
$8,000 a month.
Yeah. That translates to an annual housing cost of about $96,000. This figure alone starkly highlights the severe affordability challenge we were just discussing. Very few households in Orange County have $96,000 a year to allocate solely to housing costs, especially for a property of this nature and age. It's a payment level that simply doesn't align with the median income for the area.
What's truly fascinating here, and vital for our understanding, is that while we're observing these powerful general trends of price cuts and declining affordability across the region, there are always micro-markets, specific zip codes or neighborhoods that might defy or simply delay the broader trend. What about the forecast for this specific zip code, where this Orange County house is located? Does its local trajectory align with the overall downward pressure we're seeing, or is it an outlier?
That's an excellent question, and it highlights the nuance of real estate. Surprisingly, for this specific zip code in Orange County, our analysis actually shows a still positive price forecast, predicting a 4% increase in the next year.
Really? Still predicting an increase?
Yeah, it even registers a score of 54 out of 100 on our proprietary market strength indicator. To clarify for our listeners, this indicator synthesizes multiple market signals like average days on market, the ratio of sales to new listings, and overall price trajectory to give us a comprehensive view. A score above 50 generally indicates a seller's market, reflecting demand still slightly outstripping supply. This particular area has largely remained a seller's market over the last 4 to 5 years and hasn't slowed down much since the pandemic.
So some pockets are holding strong.
For now, yes. This vividly illustrates the nuanced nature of the market. Not every single pocket is experiencing the same immediate decline. However, if we look across the broader map of Southern California, many other zip codes in Orange County, and especially in Los Angeles, are showing significant downward forecasts. This reinforces that the market isn't a monolith. While the general trend is clearly a correction, highly localized factors like hyper-specific inventory levels, unique buyer demographics, and the mix of property types can create pockets of resilience, at least for now. But even in these areas, the pervasive affordability crunch will inevitably catch up over time.
Okay, let's move our analytical lens further south to San Diego. What's the situation there? Are we observing similar patterns of price cuts and a palpable shift in market sentiment, or are there distinct local factors shaping its current trajectory?
We're definitely seeing price cuts popping up here too, indicating a similar dynamic. For instance, just north of San Diego in Escondido, we observed a $21,000 price cut on a $1.2 million house. This particular home is demonstrably nicer than the Orange County example we just discussed, featuring more modern updates and a slightly larger footprint, but it's still, by any measure, very, very expensive.
Still $1.2 million.
Exactly. Its estimated value also peaked in 2022, dipped, recovered, and remains at a very high valuation. What's particularly striking is the owner's history with this property. They bought this house for $642,000 in 2016, so they're looking at making a truly substantial profit, almost doubling their initial investment, even with a price reduction.
Quite the return.
Well, yeah. Interestingly, they initially increased the price by 83% from their purchase price, then even more in April of this year, pushing the limits, and then finally applied this cut. This reveals that some sellers are still quite ambitious with their pricing, perhaps struggling to adjust their expectations from the peak of the market, or simply aiming to maximize their return, even as the broader market signals a clear turning point.
And what about the localized forecast for this specific area in San Diego, where we're seeing this kind of ambitious seller behavior? Given the general affordability issues we've discussed, has the market in this particular zip code started to reflect a more significant downturn, or is it showing resilience like that OC example?
For this particular zip code in San Diego, the forecast has indeed turned negative. We're now expecting prices to go down.
Ah, okay. Different story here.
Yes. Our one-year forecast for this specific area is -0.9%, which, while not a massive, precipitous drop, clearly marks the beginning of a correction. Up until just a year ago, the forecast for this very area was consistently positive, predicting continued price appreciation, indicating a seller's advantage. But the market trend here took a noticeable nosedive at the start of this year, culminating in that one-year forecast of -0.9%. This isn't signaling an imminent crash, but it is a clear indication of downward price pressure. This highlights the absolute importance of tracking these highly localized forecasts in real time, because a general positive sentiment for a broader area might have completely reversed in specific neighborhoods in just a matter of months.
Good point. Need that granular data.
Absolutely. It's a tangible signal that the supply-demand dynamics are undeniably shifting, even in historically strong and sought-after markets like San Diego.
Finally, let's turn our attention to Los Angeles. What's the situation in the sprawling, incredibly diverse LA market? Is it experiencing the same kind of corrections, or does its sheer size and broad diversity offer some insulation from these broader Southern California trends?
In Los Angeles, we are observing declining values in many different areas, particularly in highly visible and desirable neighborhoods near Hollywood, Beverly Hills, and extending down to Venice Beach. The trend of softening prices and increased inventory is quite widespread across a significant portion of the LA market. Take an example of a $27,000 price cut on a $1.2 million house that is only 1,400 square feet, translating to an estimated $830 per square foot.
Small place for $1.2 million.
Very. This house has been on the market for an extended period, 100 days, with only 11 saves, meaning very few potential buyers are even bookmarking it for later consideration, which strongly suggests it's significantly overpriced for its current condition, size, and location. The estimated value for this home, according to our data, was closer to $985,000, yet it was initially listed for an ambitious $1.3 million.
Wow, that's quite a difference.
It's a massive overreach, and it's safe to say more cuts are likely coming as the seller comes to terms with the current reality of the market. This isn't just about a slight miscalculation. It's a fundamental mismatch with current buyer expectations and affordability.
And what are the predictions for this specific zip code in LA where that particular house is struggling so visibly to sell? Does its forecast reflect a more significant downturn compared to the other areas we've looked at, perhaps indicating a deeper correction?
In this particular Los Angeles zip code, we are indeed seeing a much heavier downward forecast than the previous examples, predicting prices will drop a substantial 5.6% to 6% over the next year.
-6%. Okay, that's significant.
It is. This is a much more significant anticipated decline, pushing beyond a modest correction. The price forecast score for this area, which measures overall market health and future trajectory, has plummeted dramatically. Historically, this score was consistently above 50 out of 100 through 2022, indicating a healthy, seller-favored market. It then dipped to the low 40s, signaling a modest slowdown or perhaps a slight stabilization. But now it's at 33.
33. What does that signify?
When this score reaches 33, it's a clear and unmistakable warning sign that something significant is happening. The market dynamics have fundamentally shifted towards a substantial buyer's advantage, and sellers in this area should take notice.
And what's driving that plummeting score to such a critical level? What's the key indicator that's pushing this particular LA zip code into such a strong downward forecast?
One key reason, and it's a direct reflection of the broader trend we discussed at the very top of the show, is the massive increase in inventory in this specific zip code. It went from a relatively tight 26 homes available a year ago to a significantly expanded 47 homes today.
Nearly double the inventory.
Exactly. That's nearly double the inventory in just 1 year, a clear and undeniable indication of strong downward price pressure. This data points to a striking disconnect, as the seller of the house we just discussed, who attempted to list a property with an estimated value of $985,000 for an initial $1.3 million, clearly isn't looking at these real-time numbers.
Seems obvious they aren't.
Right. If they were, they would understand the imperative to price their house more reasonably and anticipate the decline that's coming, rather than holding out for a price that the market simply won't bear anymore. This profoundly illustrates how crucial it is for both buyers and sellers to look at these highly localized real-time metrics, rather than relying on outdated market sentiment or broad regional averages.
This market is clearly incredibly volatile, a true patchwork of strong pockets existing alongside areas of significant weakness. For anyone looking to buy or sell, or even just trying to understand their investment, getting a precise read on where your specific area is heading beyond just the general Southern California trend is absolutely crucial. It's no longer a rising tide that's lifting all boats uniformly.
Exactly. Given this inherent volatility and the increasingly localized nature of these market shifts, there are two key metrics that can truly help you dial in on what's going on in your specific city and, more importantly, your individual zip code, and understand where it's heading in the immediate future. These aren't just abstract concepts. These are powerful, actionable tools that allow you to move beyond anecdotes and general sentiment, equipping you with concrete data for informed decision-making.
So what's the first metric we should absolutely pay attention to if we want to get a true, nuanced pulse on our local market conditions?
The first is a 12-month home price forecast. This isn't just someone's opinion or a gut feeling. It's a sophisticated projection derived from a rigorous analysis of the underlying supply and demand fundamentals of a specific market, the very elements we've been dissecting, like inventory levels, sales volume, and affordability ratios. This forecast provides you with a strong, data-driven idea of where values are heading over the next year and should be a critical input in informing your strategy.
Okay, so it gives you a directional sense for the next year.
Precisely. If an area has a clear downward forecast, as a buyer, you gain significant leverage. You can afford to be pickier, take more time to evaluate your options, and feel more confident submitting lower offers because the market is trending in your favor. If you're a seller in such an area, this forecast is a clear signal that you need to be more realistic and proactive when listing your home. Holding out for peak prices is likely a losing strategy that will only result in longer days on market and potentially deeper cuts.
Got to price it right from the start.
You really do. Conversely, if your specific area still has an upward forecast, which some specific resilient pockets of Orange County surprisingly still do, you might still encounter bidding wars, and values could continue to increase into the future. This forecast acts as a critical guide for your immediate tactical decisions, shifting your approach from reactive to proactive.
That makes perfect sense. Understanding the likely direction is paramount. And what's the second crucial metric that can help us navigate these increasingly complex and turbulent market waters?
The other essential metric you'll want to examine closely is the overvaluation rate, which tells you precisely how over or undervalued prices are in your specific city and zip code compared to their long-term fundamental value.
Okay, not just compared to last year, but to the historical norms.
Exactly. It assesses current prices relative to their sustainable economic equilibrium based on factors like local income growth, inflation, historical affordability trends, and even construction costs. This metric is incredibly important because it varies widely, even within small geographic areas, as we saw with the varying dynamics in the LA examples. For example, some pockets of Los Angeles are now actually showing as undervalued compared to their long-term norms, indicating they may offer a safer entry point, while others, particularly those that experience the most aggressive price appreciation during the bull run, are still significantly overvalued.
Why does knowing whether a market is over or undervalued so critical right now, especially for someone contemplating a major financial decision, like buying or selling a home? What's the practical implication of that information?
Well, it matters deeply for risk assessment and perhaps more importantly for long-term investment security. If prices in a zip code are, say, 30% overvalued, you need to approach buying there with extreme caution because there's more inherent risk. Your investment is significantly more susceptible to a correction. In essence, prices have further to fall to align with fundamental values.
More downside risk.
Significant downside risk. This means a higher likelihood of depreciation in the short to medium term. However, if you buy in an undervalued market indicated by a negative overvaluation rate, you'll have a built-in layer of security for your investment in the long run. Even if prices drop a bit in the next year due to broader economic forces like rising interest rates or temporary recession, they're unlikely to crash by a large amount, given that the valuation metrics are already favorable and reflecting fundamental worth. This perspective is vital for making truly informed decisions in such a dynamic and uncertain market. It's about understanding not just where prices are going in the short term, but also the underlying health, stability, and long-term potential of the market you're entering, distinguishing between a hot market and a healthy one. Hashtag check out outro.
What an incredible deep dive we've taken into the Southern California housing market today. We've seen firsthand how a massive and sustained surge in inventory, coupled with an extreme, almost unprecedented affordability crisis driven by unsustainable prices and persistently high mortgage rates, is fundamentally reshaping the landscape. From the staggering affordability ratios in Orange County and San Diego, where a typical household income barely scratches the surface of a realistic mortgage payment, to the specific property examples we dissected in LA, Orange County, and San Diego, showing significant price cuts and plummeting localized forecasts, the data points clearly and consistently to a market undergoing a substantial and perhaps long overdue correction. It truly represents a complete flip from the dominant narrative we've witnessed for over a decade.
What's truly fascinating here, and a critical takeaway, is how quickly the prevailing market narrative can change based on the underlying real-time data, and how incredibly misleading broad regional averages can be. This profound shift underscores that while understanding broad market trends is important, appreciating and acting upon the highly localized dynamics of inventory, buyer demand, and valuation is absolutely
Oh,
critical.
absolutely critical.
Yeah, we've gone from a market where aggressive bidding wars were commonplace and homes sold in days to one where properties are now sitting for 100 days with significant price cuts, all within a matter of mere months. This dramatic evolution, playing out in real time across neighborhoods, serves as a powerful reminder that knowledge is your greatest asset in navigating any market. As you reflect on your own financial landscape, consider this. What specific market indicators are you tracking in your area? And how might a deeper, more granular dive into those numbers reveal a completely different, perhaps more accurate picture than the one you might simply assume from the headlines? That level of detailed insight empowers you to make truly informed decisions, or simply to appreciate the intricate, dynamic dance of supply and demand playing out in real time across the communities we call home.